when I first got in this business 35 years ago, institutions dominated the investment landscape. And this last year, to say that retail traders were starting to wield power is probably a huge understatement. Whether you can chalk this up to commission-free trading or mobile-friendly trading apps like Robinhood, entertainment forums that are investment oriented like Wall Street Bets, or maybe just government stimulus checks in so many hands. But the bottom line is that retail trading grew massively in the last year or two and has now begun to exert real power, pricing power actually, on the markets. The Wall Street Bets forum on Reddit has become a major factor as investors who talk about investments there rush into stocks that are being discussed. And acting together, these retail investors have created what's called short squeezes on hedge funds that had been betting against the retail crowd's current craze. Now, the current craze is called meme stocks. And you know, if you're like me, you keep hearing this term meme and you're not really sure what it means. Memes are just units of cultural information that are passed from person to person. We see a lot of this just in cartoons that are cute, or harpooning somebody that doesn't think like them, or things like that. But they're just little bits of information. And meme stocks are those that have gained a cult-like following on social media. And this can influence share prices when you get enough people starting to follow a specific stock. Reddit and this meme stock explosion has started creating regulatory scrutiny around things like online brokerage. Are they really watching out for people colluding like this? The regulators are very into investor protections against this type of collusion, against the gamification of investing. Investing is not a game, but some of these sites make it almost seem like a video game, which can lure people in that haven't got a clue about what they're really doing. And the bottom line is these price manipulation conspiracies. All of this is starting to attract the attention of regulators. And although the wheels of justice in this industry move fairly slowly because it's such a big, pondering industry, it's going to happen, and you're going to start to see headlines. My guess is they're going to slap the hands of the websites and the online brokerages that are just a tool in this, because it's sort of hard to slap individual investors and make headlines out of it. So the next thing I want to touch on for just a minute is cryptocurrency, Bitcoin, and there's thousands of flavors of crypto coins like that. Now, crypto is trying to come of age. And last year, we saw institutional interest for the very first time. And last year, firms like Tesla and MicroStrategy put Bitcoin on their balance sheets. And there's an outfit called Nanalyze that reports that 39 publicly traded companies now hold Bitcoin as an asset, sort of like cash. Although it's definitely not cash. I want to tell you that. Cash tends to be stable. Bitcoins and cryptos go wildly up and down in value. But the listing of Bitcoins has started to happen on the stock exchanges. We now have an exchange traded fund that is Bitcoin oriented. It doesn't hold actual cryptocurrency. It's based on futures, but we're starting to move in that direction where you can just go and buy cryptocurrencies like you would a stock. So stay tuned on that. I think we'll see more of it. But basically, crypto is democratizing finance. There's a lot of places in the world where they don't have much in the terms of formal banking. Africa, Southern Asia, places like that, a lot of places in South America. And cryptocurrencies allow people to trade with one another directly without having to have a bank account. And this is a good thing. Now, I've voiced my doubts before about Bitcoin ever becoming a widely accepted currency. I think there's structural impediments to that. But the cryptocurrency industry continues to evolve, and it may not be Bitcoin that takes the lead. It might be something else, but it's not going away, I don't think. Let me put it that way. Now, exchange traded funds, for those who aren't familiar with them, are baskets of security like a mutual fund, but they trade like a stock every day on the stock exchange. And the volume of trading in these is growing dramatically. 2021 was the biggest year for inflows into this market. That means cash moving in. And we thought we were going to see $1 trillion worth of new money into exchange traded funds last year. And we were a little bit short of that. But still, just being close to $1 trillion is a pretty big deal. One driver of this growth is mutual fund conversions. The first to happen was a fund company called Guinness Atkinson that changed their structure from mutual funds to exchange traded funds, just to gain efficiency, lower costs, and more computer programs running things rather than individual money managers. DFA, Dimensional Funds Advisors, converted $40 billion worth of funds to ETFs, and conversions being planned in the near future are Motley Fool Funds, JP Morgan, Franklin Templeton, and probably more that I haven't even heard about yet. So all this is driving growth in the exchange traded fund industry. But another driver is the growth of actively managed exchange traded funds. As you know, at Shadowridge, we advocate proactive management of investments as the best risk-adjusted rate of return that you can get. We minimize the downsides and then try to capture upsides. It takes active. You have to move in and out of investments. And exchange traded funds never did that. They were all index based until recently. As I've often said, even if you're on the right track, if you're just sitting there, you're likely to get hit by a train. By just sitting there, what I mean is if you're just holding an index, you're likely to run into problems at some point. And it's finally happening that our views are being validated by the industry. Active management is becoming a bigger part of exchange traded funds. More than 10% of all ETF inflows last year were into actively managed funds. And we saw actively managed ETF assets grow by over 40%. So this trend continues. Active management is going to become a dominant player in the ETF business over the years. So it's nice to know that the world is finally catching on to what we've been saying for years. So if you're not a client or don't have proactive management of your assets, I encourage you to give us a call at the office. The phone number will be on the final slide here, and ask for an appointment with one of our investment advisors to talk about how proactive management can help you.